Are you unsure about choosing between lump sum investment or SIPs for your financial goals? You are not alone. The decision between lump sum investments and SIPs is a common state of uncertainty for many investors. Both methods have their advantages and are suitable for different financial situations. In this video, we will dive into the debate lump sum versus SIP. When should you consider each? We will examine the scenarios where opting for a lump sum investment might be more beneficial than sticking with SIPs. For market conditions to individual financial objectives, we will dissect the key factors to help you determine the best approach for your investment journey. Welcome to holisticinvestment.in. Before delving into why and when one should opt for lump sum investment over SIPs, let's define what exactly is lump sum investing. Lump sum investing involves putting a substantial amount of money into an investment all at once, typically in a single transaction rather than spreading it out over time. It is a one-time investment rather than a regular contribution. Determining when to invest via lump sum. Let's now explore the situations where a lump sum investment might be more beneficial compared to the widely followed SIP strategy. First, capitalizing on market opportunities. Investing a lump sum during market downturns or when significant growth opportunities are anticipated can be advantageous. For instance, during the COVID-19 pandemic, when the markets experienced steep declines, investing a lump sum yielded substantial returns as the subsequent bull run lasted for an extended period. Similarly, identifying sectors poised for growth and investing a lump sum ahead of anticipated upward movements can lead to significant returns. However, such opportunities are rare and may require patience as they may take years to materialize. Next, stable market phases. During periods of market stability with low volatility, making a lump sum investment can yield favorable returns. These phases serve as a foundation for potential long-term growth, making lump sum investments attractive. Next, debt investments. While SIPs are commonly used for equity investments to benefit from market fluctuation, lump sum investment can be advantageous for debt investment. Unlike equity markets, debt markets are less volatile, making the averaging effect of SIP less significant. The chart here shows the volatility in the debt and equity funds since 2010 based on a 1-month return. So in debt funds, by investing and holding on to the fund for the appropriate duration based on its category, you can effectively reduce volatility. But in gilt and dynamic bond funds, you might experience a decline in your fund's return if the interest rate cycle increases. However, as long as your investment horizon aligns with these funds, these downturns will balance out over time. Next, consideration for smaller lump sums. When receiving smaller lump sum such as an inheritance or bonus, investing it strategically alongside an existing investment portfolio can be beneficial. However, the impact of the lump sum on the average price of existing holdings must be considered. If the lump sum constitutes a smaller portion of the portfolio, its effect on the average price may be minimal, maintaining the average effect achieved through consistent investments over time. It is important to note that the optimal percentage of a lump sum investment depends on individual portfolio worth and goals, and there is no one-size-fits-all approach. Lump sum investment for fund switching. Lump sum investment hold significant advantages, particularly when switching funds within the same asset class, whether it's from one equity fund to another or from one debt fund to another. When you are switching within the same asset class, the risk profile of both old fund and new fund remains the same. Compared to methods like SIPs and STPs, lump sum investments offer clear benefits in specific scenarios. While SIPs and STPs aim to average acquisition cost over time, they may not be as effective when reallocating funds within the same asset class or shifting from an underperforming fund to a better performing one. Since both the source and destination funds belongs to the same asset class, these methods may not adequately address the objective of reallocating funds within that class. In contrast, lump sum investments provide a direct and efficient means of achieving this goal by swiftly transferring funds from an underperforming to a promising fund. Investor can seize market opportunities without being constrained by averaging strategies. This approach facilitates the prompt reallocation of resources to better performing assets, potentially enhancing portfolio returns over time. Similarly, the same principle applies when considering transitioning between asset classes. Moving from debt to equity may not be advisable unless it is for portfolio rebalancing purposes. It is crucial to maintain a balanced portfolio that aligns with your investment goals and risk tolerance. Moreover, there may be instances where transitioning from equity to debt becomes necessary as you near your financial goal. This could be when you need to protect accumulated wealth by transitioning it to a safer investment avenue. In such cases, utilizing a systematic transfer plan from your equity portfolio to the debt segment can be advantageous. This strategy allows you to maintain exposure to equity while gradually transferring the corpus to debt, maximizing the potential for return while mitigating risk. It is imperative to exercise caution when transitioning between asset classes, particularly from debt to equity. Such moves should be driven by strategic portfolio rebalancing needs rather than impulsive decision influenced by short-term market fluctuation. Investors must carefully assess their risk tolerance, investment objective, and time horizon before making any significant portfolio changes. In conclusion, determining the optimal use of lump sum investment in the market requires a thoughtful evaluation of several factors including prevailing market conditions, portfolio size, investment objectives, risk tolerance, and asset allocation. Through diligent research, careful consideration of individual financial situation, and seeking guidance from financial experts, investors can make well-informed decisions that are in line with their long-term investment goals, enhancing the potential for investment success. Ultimately, the decision to utilize lump sum investment varies based on each investor's unique circumstances and preferences, and there is no universal approach that suits everyone. Happy investing! A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.